that I don't own gold because I think it might go through 2,700 or for that matter, 3,000. I own it because I'm afraid it's going to go to 9 or 10,000. Will it do that in lockstep as a straight line? No. If you're a trader, if you're somebody who's afraid of volatility, if you can't afford to remain long, by all means, take trading profits. That's not how or why I own gold. I own gold to maintain my purchasing power. By my measure, gold didn't start moving 3 years ago. Gold started moving in the year 2000. If you look at the 24 years that we've been through, gold has increased in price by about 8% compounded a year for 24 years. Gold has maintained my purchasing power, which is precisely why I own it. Is the pace of the escalation of the gold price picking up? Yes. And in the face of political pressures on the Fed to lower their interest rate, which is a different way of saying devalue the yield on the U.S. dollar, should gold continue to accelerate? Yes, if all other things remain equal. Again, though, your technique with regards to gold, your strategy with regard to gold, will relate more to you than to gold.
And it's interesting to see the price of gold's been going higher here in the last couple of months, even in the face of a strong U.S. dollar, which I believe is up 3% this month.
That's a very good point. Doug Casey's old joke is that the U.S. dollar is the worst currency in the world, except, of course, all of the others. In my experience, markets like the markets that we're seeing now, markets where the pace of gold appreciation escalates, sees gold appreciate not just in U.S. dollar terms, but concurrently with the U.S. dollar, which means in other currencies, gold isn't merely appreciating, it's rocketing. This is not inconsistent with the experience that we had in the early part of the decade of the 1970s. It's also not inconsistent with the performance of gold relative to other currencies that we experienced early in the decade 2000 to 2010. This is completely concurrent with the ramping up of a gold bull market. Whether past is prologue or not is a different question. I believe it is.
Gold has climbed 8% annually for 24 years, and Rick Rule argues it's not done yet. Imagine gold hitting $10,000. While others fear short-term volatility, he sees a stable store of value that's held its power since 2000. Why? In a world where debt and dollar devaluation dominate, he believes gold's role as an inflation-proof asset will only grow. Drawing on lessons from the 1970s and early 2000s, he highlights how mounting U.S. debt and relentless government spending could mean the dollar buys less every year, making gold a critical defense against declining purchasing power.
It's important that you remember that the decade of the 70s saw the legal decontrol of the price of gold. In the early part of that decade, gold had been price controlled, as it had been for 30 years at $35 an ounce. So part of the move that you saw in the gold price in the decade of the 1970s was the simple removal of price controls and the legalization of gold ownership by Americans. Remember that in that decade, and some of your listeners are too young to remember, that the gold price went from $35 an ounce to $850 an ounce. My suspicion is that had gold been decontrolled and Americans had been allowed to own it, that it would have begun the decade at $100 or some number like that, so that the escalation in price would have been eightfold. That's consistent with the experience that we had in the decade 2000 to 2010. The gold price escalated, if my memory serves me correctly, from $253 to some number like $1,700, a 7 or 8-fold increase in the price of gold. I'm not saying that we're going to get that dramatic a move, but let me put it differently. Let me suggest to you that the gold price in the period 2000 to 2024 hasn't moved up at all, but rather that the dollar has in fact moved down. That it takes more dollars to buy an ounce of gold, but an ounce of gold buys you the same amount of goods and services as it did in 2024. If you look at it from that metric, my suspicion is that the next 10 years will be very good for gold indeed, measured in dollar terms. Here's why. In the decade of the 70s, we alleviated the stress of debt and deficits. We alleviated the overvaluation of the U.S. dollar by devaluing the purchasing power of the U.S. dollar. By the U.S. government's own estimates, we devalued the dollar in terms of its purchasing power by 75% in the decade of the 70s. I believe that past is prologue. I believe that the dollar will buy you 75% less in goods and services in the 10 years coming relative to today. Why do I believe that? The on-balance sheet liabilities of the U.S. government are $35 trillion and counting. The off-balance sheet liabilities of the U.S. government are $100 trillion and counting. I don't believe it's physically or politically feasible to renounce things like Social Security, Medicare, Medicaid, and I don't believe that Congress is going to stop spending. So rather than obviate our so-called obligations to each other in entitlements, I think what we do is we inflate away the net present value of those entitlements. In other words, if you believe that you're entitled to $2,200 a month in Social Security, you'll get it. But that $2,200 will only buy $400 or $500 worth of goods and services. The constant in terms of valuation for the next 10 years is likely to be what it's been for the last 1,000 years, which is to say gold. You said at the top of the show that inflation has begun to moderate. That's only if you measure inflation by the CPI. The government would have you believe that inflation, which they define as the escalation in prices of a select basket of goods and services, is increasing by 2.6% a year. I define inflation as the deterioration in the purchasing power of my savings and my salary against a basket of goods and services that I buy. And by my measure, my savings are deteriorating at 7.5% compounded, not 2.6. I would urge your listeners, as a thought experiment, to think about their experience in the last 4 or 5 years. What's happened to the price of groceries? What's happened to the price of gas? What's happened to health insurance? What's happened to housing prices? What's happened to rents? What's happened in the last 2 years to mortgage payments? If you measure the deterioration in purchasing power against the basket of goods and services that you buy, not the ones that are hedonistically adjusted, or, like the CPI, not ones that don't include tax, what I think you'll find is that inflation defined as the deterioration of the purchasing power of your savings and your salary relative to the basket of goods and services that you consume is increasing at a rate much closer to 7.5, perhaps even as high as 10, relative to the government's estimate of 2.6. And I think that understanding is important for your listeners in terms of planning their financial future and how they save. The lack of performance overall of the gold shares relative to gold is easy to explain. Until 20 weeks ago, the buyer of gold was mostly central banks. There was no retail participation. And central banks don't buy gold shares. So if one market went up because there was a buyer and that buyer was absent from the other market, I think it completely explains the dichotomy. In terms of the relative outperformance of Newmont relative to Barrick, I think it has to do with the fact that Barrick has guided their production lower and Newmont has guided their production higher as a consequence of their acquisition of the assets of Newcrest. I think that there's a belief on Wall Street that Newmont's stated strategy, which is to sell all of their Tier 2 deposits, use the proceeds to strengthen their balance sheet, and focus their love, care, and attention only on their Tier 1 projects, is something that's caught Wall Street's fancy. But I think generally that gold equities bull markets are always led by the biggest and the best. So you're seeing names like Agnico Eagle and Franco-Nevada and Newmont, the low-stress names, catch a bid first. That's traditional. We've seen that through the last 4 precious metals bull cycles. Think of a gold equities bull market as resembling the trajectory of a circus master's whip. The lower risk companies are at the front of the whip. They move first, but they have the shortest distance to go. As we go up, down the quality trail, we go up the whip. The mid-tier producers are next. They move after the top producers, but they move further. And then finally, of course, at the end of the bull market cycle, you have the penny dreadfuls. They move last, but they move the furthest. It is possible, if you pay attention, that your own portfolio can match that same trajectory, albeit you take increasing risk, both in terms of the companies and in terms of the fact that When the worst companies move, you are towards the end of the market. So you run the timing risk.
Now you know why gold might just be the ultimate shield against dollar devaluation and inflation. But to really grasp where this trend is headed, you're going to need to know about another critical shift happening right now in global markets. So check out the next video on our channel to stay ahead. And if you found this helpful, make sure to like, comment, and subscribe for more insights.